I always like to start off every week with a summary of kind of what we saw happening with the market this week. So let me switch over to the chart that we look at here. Uh, this is a great time to be an investor. I mean, really, since October 27th of last year, so almost a full year now, we've had a continuous run here. We had, some interruptions in April, August, September, but otherwise, what are those? I think the worst one was in August. It was 8.5% from high to low, was the drop. And we're right now today as we sit, we're sitting at another all-time high, which would be the 45th all-time high for the year. And it's kind of amazing, actually. September is historically a negative month by a little bit, I think 0.6%, looking at September long-term on the S&P 500. We made money last September, even though it's kind of an election year. And again, election year 60 days prior is usually soft. Here we are in October, setting continuous new highs. Maybe we won't have as great a November, who knows? But the market is really, really going. It's going very, very well, and there's reasons for it. If you look at kind of what's going on, I mean, the Producers Price Index just came out today, which is the wholesale price index. It was down from where it was over the last couple of months. And that's a good sign, as if I think it was at 1.76%. So, if it's lower, that's working its way through the food chain, so to speak, right? So if your wholesale inflation is lower, maybe your top line inflation will also be lower coming forward. So, we had the Federal Reserve that lowered rates by 0.5 point. The next meeting is November 7th. So you've got an environment the stock market loves, which is lowering of interest rates. The average rate of return is 14% after the first rate cut in the last 11 rate cut cycles, and money was made in 9 of those 11. Right, so pretty good stats here. I'm telling you, there's a lot of things stacking up for this market to be quite decent and continue to be well. Basically, there's just a momentum that's happening here, and people are buying in, and the cash flow's coming in, and maybe October becomes sort of an anticipation month in a presidential year, where everybody can see the data historically that November is a good month, especially after the election, and people start buying early into that. I remember way back, the January, we used to call it the January effect, and then it became December because everybody was anticipating January and buying December. And now November is the highest average rate every month, probably anticipating December. So, these trends over a long period of time can change as far as that goes. But this has been phenomenal, really. I'm really happy with what's going on. We are seeing still within the market itself, if you look at kind of the sectors, we're seeing this rotation that's happening on a really fast basis, almost daily, from one sector to another. All of a sudden, this sector's hot. And again, this is very similar to what I remember from 2021, and you really need to focus on the broad portion of your portfolio, right? Having all the pieces. We've seen some great runs out of small caps, then all of a sudden that kind of stops. We've seen, technology has made a couple runs here, but not enough to be as good a momentum maker as it was earlier this year, right? So that's where you really want to focus on having kind of like the Vanguard Total Stock Market Index type pieces in your portfolio that can kind of capture everything. Because in 2021, when you were trying to capture momentum in the segments of the market, very difficult because it just didn't last long enough for you to kind of get in and out and to outperform the market versus just holding on. I think VTI or Vanguard Total Stock Market Index in 2021 was up 27%, for example. So you'd have done fine to just kind of hold on to that. That's the kind of market we're seeing here. Maybe a trend develops here after the election, maybe because of who gets elected. People start to bet on one particular area or another with anticipation that, that area is going to get more attention under this particular administration, whatever that is. But we haven't seen that for a while, really since about May. May, June timeframe is when kind of the trending stopped as far as that goes. So nothing wrong with that. The broad market, which the S&P 500 does a decent job of representing, doesn't have small cap, right? But it has some mid cap, mostly it's large cap, but still very, very good index. So if you look at what's going on, there's a change today that happened here. The top part there shows by increment, so hourly, daily, weekly, or monthly. So when we're looking at the chart in those different time frames, it's kind of fractal. You're looking at each segment in different time frames, And as of September 19th, they're all green. They haven't changed, right? Still green. Everything is in a primary uptrend. Had a couple times here where the hourly turned down, and those downturns that started, July, mid-July, and beginning of September, but everything is green. Now, going back to June 3rd, we have had everything green except for transportation, right? So it's been red. Today, it's just gone green. So I don't know, you can't get much better than what's happening here. So the second part there is the market breadth. It's looking at all of these different segments of the market as a whole to see if they're in a primary direction up or down. It's not meant to be a pre-warning indicator. We don't really look for that pretty much because we don't believe you can get in and out on a short-term basis per se. We're looking more for confirmation that this is a big downturn. And it could get bigger and bigger. Those are the ones we want to try to make some changes to the portfolio to try to step out of the way. And again, you have to be careful. If you get in and out all the time, last year was such a great example. That was a pretty violent 10% downturn that happened last summer. It would fake up and not quite make it and then fail, and lots of articles about, we're going to fall a lot farther, what have you. And if you didn't have the right setup, you might have gotten out, and man, you would have really missed. Because like the first, October 27th was that bottom, and I think the first week after that, it was up 5%, and it was up 8.9% for the month of November as a total. So you can miss out on upsides really fast if you're trying to get out on these smaller moves. Now, what you want to see is the primary direction changing to the downside, and that hadn't happened at that point in time. So that's why we stayed in, for example. So that's what this is to help us with, is kind of combining with the primary direction, what is going on. And we can see, for example, when the primary direction changes, you'll see the hourly, daily, monthly, and weekly start to all go red, right? And so that's, confirming, that we're in a much bigger downturn, and maybe we'll have more momentum to the downside going forward also. And so the big news this week, or the big report, I suppose, was the Consumer Price Index. This is going back 5 years. So it came out yesterday. Market dropped a little, 0.2%, right? Because the expectations were a little bit better than what happened. So
they were expecting 2.3.
Yeah, they're expecting 2.3% year over year. So in this case, we're looking at this September versus last September. And the expectation was, hey, it's going to drop 2.3. It dropped 2.44. Or it ended up at 2.44, right? But the market's up today. There's some other reasons that it's up today, and we'll talk about those in a minute. But I felt very confidently that the market would shrug this off pretty quickly, only because 2.44 is the lowest, top line CPI inflation rate we've had going back to the very beginning of 2021.
Yeah, I think February was the last time it was below that.
Yeah, I mean, you can see essentially it's been going more or less sideways for quite a while, right? And we're not really getting down maybe to the levels the Fed wants. Please keep in mind the Fed is not looking at this measure when they talk about 2%. They're looking at core PCE inflation, which comes out at the end of the month. We'll talk about that also. However, they're fairly well correlated. This is coming down, core PCE is coming down, but they're both doing it in the same way, really slowly in the last 4 to 6 months. And so the Federal Reserve lowered rates 0.5% in a time frame when inflation really isn't falling that much. And that has to do with the fact that they have this dual mandate, right? Full employment, which they consider about 4%-ish, unemployment, interestingly enough, and, inflation at 2%. I think they're showing, I believe, that they're okay in a 2 to 3% range, which I think is, as a matter of fact, there's a whole bunch of economists that have come out and said that that's what they should do. So maybe they're listening. They haven't said anything about that. They're still talking about a 2% target, but they just did a 0.5 point rate cut in a time frame when we're not quite there yet, and the trend is sort of sideways and not really down. They didn't want to wait until we got there because then it could go below that, and we could end up in a deflationary.
You're trying to slow down a train. It's hard to stop on the dime.
Yeah, which is fine, but 0.5 point was kind of a big deal. So the next, big piece that really has been driving the market today and kind of coming back is earnings season started. And the banks that reported earnings, J.P. Morgan, Wells Fargo, both had good earnings reports. J.P. Morgan was up 5% before the show started. Wells Fargo was up 6%. And so that's exciting. And we've got, earnings season is here, right? We're going to get, and the big week is that week where we get Apple and Microsoft and what have you. And of course, the really big week is way late is Nvidia, because that's seen as sort of the bellwether for the whole AI movement as far as that goes. And again, we talked about last week all the catalysts that are out there that are driving the market, and that hasn't changed. I mean, this is continuing to kind of go and go. And so one of the catalysts will be future rate cuts. And so, again, we presented this last week. Not too long ago, it was about a 56% chance we'd have a half a point rate cut. Last week, that disappeared.
Yep.
Because the data is coming in. It's showing inflation isn't falling as fast. So people are thinking, okay, maybe we don't need a half point. And the jobs report came out, it was very good, those types of things. So we were at a 3% chance that we would have no rate cut. Well, that, as of this week, as of today, is now up to a 10% chance. I'm going to go out on a limb, and I wouldn't be surprised. There was, if you look at the minutes for the last meeting, there was quite a quite a debate about whether to do a quarter point or half a point, and they ended up doing a half a point. I think the debate this time is going to be pretty, good about whether to do a quarter or zero. I think zero's on the table. The data continues to come in. It's showing inflation is doing okay, but it's not coming down a lot. The unemployment report, I will say, this week was the highest it's been in a year. Every week there's a thing called first-time unemployment claims, and it actually been trending down for the previous 4 weeks quite nicely. But then this week was the highest it was for the past year. So that bodes towards doing a rate cut, right? Versus then we see CPI was a little bit higher than expected. That bodes toward doing no rate cut.
Yeah, I believe the Fed will be able to see one more jobs report prior to their
that one more jobs report, and of course that weekly unemployment claims comes out every week. So that's something that they'll be able to see. And there won't be an inflation report. Oh no, there will be an inflation report. The PCE will come out at the end of this month, so that'll be interesting to see. As far as that goes, so this is what the market's looking at right now. But keep in mind, if you step back from kind of the day by day stuff and you look at what's going on, the market is a leading indicator, okay, for what is going to happen in the economy. That confuses people a lot. I remember my grandmother used to always ask me, why is the market going up when there's, unemployment is going up, and because the market's looking 3 to 18 months forward, and unemployment is a current lagging indicator, right? And so, and that's true for so many things. And I'll mention this again, but the leading economic indicator, the LEI, it's a big one. It's been very well followed. Has only 10 indicators in it, and the S&P 500 is one of them. So if you see the S&P 500 doing what it's doing right now, we would expect the economy over the next 3 to 18 months, and more importantly, the earnings of companies, which is really what the market's looking at, to continue to improve during that period of time. When you see the market turning down, things might be rosy, because what we have to realize is there's so much money in the market that it attracts all of this resources and infrastructure and intelligence to look at what's going on with earnings in the future. And so, it's not insider trading. It's just understanding at a deep level every one of these companies. They're tracking, retail organizations by using satellite imagery of their parking lots and how many cars are coming and going. I mean, you wouldn't believe how much money goes into determining, what future earnings might be. And so you don't need to spend that much money yourself, in my opinion. Watch the S&P 500. It's why we talk about it all the time, because when it starts to turn down, expect that there would be some hard times coming as far as that goes. The opposite of that is happening right now. Expect earnings continue to do well when the S&P 500 continues to do this well. There's always this caveat that I always throw up, that there are things that can happen that would throw this train right off the rails, right? I always use the China, invading Taiwan scenario, but there's others, obviously. But barring those, looking at how the market works, looking at the momentum that the market has, looking at, the future of what's going on, this is going to continue. I mean, we're still early in a typical upward market move, right? And so, we'll see. The down market that stops the bull market, the up market, is a 20% down market. And so theoretically, we're still a ways away from that, looking at the average length of term that a market runs between 20% down market. So, we'll see how that plays out. So anyway, that's the summary for this week. Great time to be an investor. We're over 5,800 on the S&P 500, which is awesome. I think we have a good shot at getting over 6,000 if we continue on this pace, which, on a percentage basis isn't that far from here. It will be interesting. I bet you we have some trouble getting through 6,000. We always do. These big numbers, there's lots of resistance there. People are selling at those high points, but I wouldn't be surprised to see us close over 6,000 this year based on what we're doing at this time, right? So that's the summary for this week. Very happy that you're able to join us for that. Look forward to doing it again next week.